You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalog and listen to the past episodes that you may have missed, like my conversation with Alan last week, where we introduced the new amazing mini-series, where I think we're doing something that has never been done before, as we have managed to line up most of the largest managers in our industry to discuss the most important topics about their strategies, the business, as well as the industry as a whole. And we can't wait to start sharing these conversations with you, which I believe we will start doing on Monday. Also, if you missed our Wednesday episode, I really would encourage you to listen to the midweek conversation we had with Susan Shirk, who is probably the foremost expert on U.S.-China relationship and who takes us behind the red curtain to explain how China essentially derailed from its peaceful rise. So I really encourage you to go back and listen to these episodes if you missed them this week, but not until you finished listening to Rob and I today, of course. Rob, it is wonderful to be back with you in the new year, and so much happens every time we are apart, so to speak, in our conversations. So how are you doing? How are things on your side?
It's wet and rainy outside as I speak, so it feels like proper kind of wintry weather now. And as we were discussing before we started the recording, I've got a bit of a cold, which will explain I don't know, I think my voice sounds a little bit sexy like this, a little bit gravelly, so hopefully the listeners will enjoy the change in tone.
Yeah, no, I'm sure they will. They might even enjoy the content as well. You never know.
Oh, that would be going a bit far, Niels, surely.
All right. Okay. Well, we do actually have some good topics in our unbiased opinion, of course. But before we do that, here's a little market wrap, because there obviously have been a few things going on this week. Before I do that, maybe as it is the first SI episode in the new year, let me just acknowledge and say a big thanks for all of you who left a rating and review in the last few weeks on iTunes, Spotify, Amazon. It is, first of all, they're really nice. And secondly, we do pay attention to them and we do appreciate them very much. Now, this week, it was all about the December CPI report. It was released on Thursday, and it was a pleasant surprise for long-only investors. The headline CPI fell 0.1% month over month, and the year-over-year measure fell to 6.5% from 7.1% in the previous month. Now, core CPI, the measure that excludes food and energy, rose 0.3% over the previous month, a slight uptick from the 0.2% in the previous report. Core CPI has fallen, though, from 5.7 year over year, or to 5.7 year on year, from its peak of 6.6% reported last year. The market breathed a sigh of relief, as witnessed by the massive rally in the long bond on the day of the release, closing nearly 2 points above the previous day's close. Much of the rally seemed to have been driven by short covering and driving the yield to maturity down to below 3.6%, I think. And at that yield level, it's hard to justify perhaps buying on fundamental reasons only. Also, on Thursday, Philadelphia Fed President Harker said the days of the 75 basis points hikes are surely behind us, and that the 25 basis points hikes will be appropriate going forward. Those comments and encouraging CPI release has driven consensus to expect 25 basis points hike at the February 1st FOMC meeting. He also said that a soft landing was still possible, even if it was bumpy. What he probably means is that the economy may avoid recession, but that the unemployment rate will rise. And reading the outlooks for 2023 that have been published so far, that view is a bit out of consensus. Pundits are expecting a recession later this year, and Fed fund futures are predicting a rate cut later in the year as well. For their part, no Fed speakers are hinting at rate cuts anytime soon. And although this is not market moving and not really mentioned in the press, but the Federal Reserve open market portfolio of holdings fell below 8 trillion for the first time since its peak at nearly 9 trillion last April. As a reminder, the Fed is letting the portfolio run off to a tune of $120 billion a month right now. Next week, we're going to get a measure for how the holiday selling season fared when retail sales are released on Wednesday. All right, Rob, what has stood out to you in the last, 6 weeks since we last spoke?
Yeah, I was just looking at the year-to-date numbers, actually, not gone back as far as 6 weeks. It's been, I guess it's been a kind of fairly smiley, positive time for the markets, right? So both bonds and equities are up, vol is down. So if I look at my market monitor report that takes all the moves across all the 200 or so futures markets I monitor and vol adjusts them to put them on the same scale, then the biggest fallers are V stocks and VIX, so they're vol markets, obviously. And then on the plus side, I can see a lot of equities, Euro stocks, DAX, some European stocks seem to have done particularly well. The rally in fixed income actually is not showing up in that report, so it's not that significant. Unfortunately for my portfolio, it was rather significant, so I have a short bond position on, and I'm still short bonds actually, so I haven't closed that position yet. And that lost me a little bit of money, so I'm actually down for the year to date 38 basis points, which it's not very much, but it's only been a couple of weeks, so pretty much noise. Without those bond positions, I would have been up. So that was a bit painful because I'm short vol, so that made me money. I'm also long various equity markets, so that also would have done pretty well, I guess. Looking forward slightly, so I'm still trading with relatively low risk, running at about a quarter of my long run average expected risk target at the moment. Biggest position is still short bonds, short US 20 years. My biggest long position is long position's actually not a bit more dispersed. There's nothing that stands out, but I'm long equities, as I've said. I'm long metals as well, as it happens. I'm short vol, which is like being long equities, if you like. So I still have a very much a kind of long equity short bond position on, which with the way the market's moved over the last couple of weeks, this beginning of the year is fairly balanced. Those two things have pretty much hedged each other off and left it out a small loss. So we'll see what happens if this bond rally continues. And obviously, I'll expect to close out that bond position and have a fairly then sort of pro cyclical position on. And who knows if inflation has peaked and is falling, and if all recession risk is priced in, then yeah, maybe that will turn out to be a good year. We'll see how it goes.
Absolutely, yeah, it's interesting. And you mentioned volatility a couple of times. If my memory serves me right, I thought I noticed that I think vol or VIX is kind of hovering around just above the low of all of last year. I mean, it's really been pushed down. And if you think about it, we're heading into a new year. A lot of the crises from last year are completely unresolved, yet volatility in the markets, or in the equity markets at least, are not suggesting any concerns, really. So, yeah, could be interesting.
I mean, just to say, I think there's some weird stuff going on in the vol markets, actually. So it has been a bit of a puzzle that in a year in which, equities sold off pretty radically, vol hasn't really been elevated that much at all. And now is, as you say, is very low. And somebody drew my attention, if you look at the put call ratio, which I think Bloomberg publishes, it's a historic high. And the other weird thing that's going on is there's been a big increase in people trading very short vol, like 1 week options, which means technical terms means there'll be a lot of gamma hedging going on. And I'm not a vol guy. You have vol guys on the podcast who will be able to express their opinions better on those, but the vol market, certainly for the last 18 months or so, to me, has felt really strange and almost disconnected from the equity markets, it's kind of that's kind of an unsolved puzzle for me.
Yeah, no, it has been a conundrum, and actually the way that Jim and I think Harry has spoken about it is really that this year, or I should say last year, investors just seem to have been much better hedged than before, and therefore there's been a much more supply, and therefore we've seen these unusual periods with very little spike in volatility when markets were trading off. Now, in terms of trend following, I will say the first couple of weeks have been a little bit soft. I think softer than your portfolio. I think your portfolio actually is doing pretty well. I think CTAs in January are giving back a tiny bit of the profits from last year, which of course was a record year. Let's not forget that. There were, however, so on first sight, I would say this week probably not a lot happened, even though we had a little bit of excitement from the CPI report. But in a diversified portfolio, I don't think that it played a major role. But when you then look and drill down a little bit, I did notice that things like aluminum had a bit of a turnaround and suddenly had like 5 or 6 pretty strong days in a row against the longer term downtrend, at least if you're a longer term manager. And I think it made a new sort of recent high every single day of last week. So that's going to cause a little bit of pain for longer term trend followers. But offsetting that, I would also say that another market that had a pretty good week was the Mexican peso. It's been in a big uptrend for a while now, and I think that certainly helped out most trend-following portfolios last week. Otherwise, when I look through a kind of a diversified portfolio, I would say fixed income, as you suggested, that's where most people would have lost the money last week. As it went higher on the back of the CPI data, but maybe also in metals, although I did notice that you said you were long, but I think a lot of people are still short. Equities probably mixed, depending on which part of the world you're looking at. I think energies probably made a little bit of money, so did soft perhaps, and then grains and meats were pretty flat. My own trend barometer, though, has picked up. Now it's 55, which is getting close to a nice level. Now, of course, people might think, well, if trend followers are down for the month and the trend barometer is up in a strong level, how does that work? Well, the trend barometer is a much shorter term time frame in terms of how it's calculated. So I think that if it stays up for a while, then maybe trend followers will also start to do, or longer term trend followers will do better. Anyways, in terms of data, it's super easy because month to date and year to date is the same. So I just have to mention one of them. B Top 50 down 0.6%. SocGen CTA index down 1 and change. Trend index down 1.32%. And the short-term traders index is up 0.25%. And that is, of course, as of Thursday evening. Other than that, MSCI World obviously having a strong start to the month, up more than 5%. Government bonds up more than 2%, and the S&P 500 index up more than 4% so far. All right, well, let's jump into some of the questions we had coming in, some of them a few weeks ago, but because of the holiday schedule, we're going to bring them up now. So first one for you was from Andrew. It's about his moving average crossover journey. Andrew writes, I was using the 16 and the 64-day exponential moving average crossover, but found that I was getting in and out of trades at nearly the exact same price after long journeys in both directions. So I switched to a 5-day and a 20-day EMA crossover. Using 5 and 20 EMA, I was using stops at 1.5 ATR at entrance to stay in the trade, but I found that I was getting stopped out, but that the trend would continue. So I stopped using stops to wait for the crossover to occur, and then I found that I was taking 7 to 12% losses, which is not cutting losses short. Also, sometimes I was entering the trades late based on the trend following study that said it's better to be in the trade than to wait for the next entrance. Questions: should I use a stop or wait for the crossover to occur before exit? And second question, should I only enter trades right at the entrance? So, Rob, what are your thoughts?
I have to say this is interesting because I think this is a very common story for a lot of people. So if I just summarize what Andrew's done, Andrew said, well, I've got this system A and I started trading it, but it didn't do what I expected, or it lost some money when I started trading it, or I wasn't happy with it. So I switched to system B. The same thing happened again. It didn't do what I expected, or it lost some money, or so I switched to system C. And now what Andrew seems to be saying to us is, right, what's system D? What's the next thing I should be doing? But to be honest, Andrew, what you should be doing is just sticking to one thing. So if I look at your first system, which is a 1664 crossover, that's a pretty good system. If you're going to trade a single crossover, it's not too fast, but it's fast enough that it captures trends fairly quickly. In my own empirical research, I actually find that's the best out of particular set of crossovers you can use. Just to add, the difference is not statistically significant. It's only the other crossovers either side do pretty well as well. And to be honest, you're probably better off trading a blend of crossovers, but we'll come to that in a minute. So there's nothing wrong with System A, okay? You should have just stuck to it and carried on with it, and be prepared for the fact that over a relatively short period of time, Andrew doesn't say, the time period between each of the decisions. If he was trading the first system for 20 years, then okay, perhaps fair enough. But my suspicion is that's not the case.
And also he doesn't mention how many markets he trades, which I think also is a very important factor.
Yeah, definitely. Yeah, because obviously, if you're trading a small number of markets, as a retail trader typically is, it might be that over a relatively short period of time, you might just get unlucky, and the crossover you're using just doesn't work. Kind of moving on to the specifics of his questions, like which crossover is best. You're better off using a blend of crossovers. If you were to use a single one, personally, I'd plump for 1664. But really, the key message here is to find something and stick to it. As to the questions whether you should use stops or wait for the crossover to change when you get out, that this is a kind of, to be honest, it's down to preferences. To be honest. Again, in my research, I found a small improvement if you use the crossover on the stop, but there's nothing wrong with using the stop, and it makes the system simpler and easier to understand as well, and easier to run manually. So that go ahead and use the stop. Just be careful that the stop is calibrated such that it's getting you out of the trades at about the right level. And I would say he says 1.5 ATR, I would say that's way too tight, probably for the speed of crossover he was using. For the original 1664, I would use probably 7 ATR as my stop, because that will give you something that will it's not about optimizing the ideal exit. It's about making sure that the stop is sort of aligned in time with the holding period of the underlying trading signal, if you like. And if he goes on my blog or buys my third book, Leverage Trading, there's a big discussion in there about how you can actually match these things up. If that's the route he wants to go down. But yeah, Andrew, the key thing here is you've got to find something that you're comfortable with and you understand, and just stick to trading it. I feel like you're kind of almost quite, I hate to be rude, but quite a bad advert for systematic trading, because what you're doing is not systematic. You're switching from one system to another system, based probably on insufficient evidence and understanding of what you're doing. So, find something you're comfortable with. Make sure you understand the characteristics it's likely to have, and then just stick with it.
Yeah, and just one more thing to add there, and that is, I think you should also think about what your backtest looks like, because there must have been some evidence of what you're seeing in real time in your backtest as well. So it shouldn't come as a surprise. And again, I have a suspicion that it could also be to do with the number of markets you trade. Anyway, let me make it absolutely clear that, of course, whatever Rob is saying with specific things, this is not investment advice, and we don't, we take no responsibility whether these things work or not. But this is just, ideas to go and do your own due diligence and checks and all that stuff. All right, then we move on to a question from Joseph. Joseph writes, huge fan of all the work. Thanks for your generous contribution to the trading community. Question, is running your own trend following portfolio a reasonable idea in 2023, given the vast number of professional funds available and the importance of an ensemble approach? Said differently, do you think the professional fees paid to external managers are easily offset by the ability to take greater risk in an ensemble and the benefit of being a passive investor? And two, and then he says the impressive track record of Don and others set the bar extremely high for new managers and DIYs. We've talked about this before, actually.
We have. This is one of those how long is a piece of string questions, to be honest. So if you take someone like me, who's obviously quite comfortable and experienced in running their own trading system and has a reasonable amount of capital to do it with, then it probably wouldn't make a lot of sense for me to go and take my money and go and invest in a bunch of funds. I wouldn't I wouldn't get much extra return from doing that. And I have so much fun trading my own money as well. So there we go. But at the other extreme, if you take someone who is not as experienced and not as comfortable, and also doesn't have has a much smaller amount of capital, so perhaps a few $1,000 or euros or something like that, then you're gonna struggle to trade a diversified set of instruments that's going to give you much of the performance of a diversified portfolio. So let's just talk very quickly some theoretical numbers, and then I'll pass it back to you, Niels, for your opinion. So I would say very roughly, it seems okay to assume that a very large diversified fund can achieve a Sharpe ratio of perhaps 1 to 1.2 before fees. And an individual investor trading a small number of markets is probably looking at maybe a quarter of that. And so the 20%, if you assume you've got a 20% performance fee and a couple of percent management fee, then you work the maths out, and that individual investor would be better off in putting their money in a fund, and if even better if they can do it via UCITS funds into an ensemble, if you can find a dozen CTAs with UCITS, put it into a dozen UCITS funds, that'd be great. To do direct investment into a large number of funds normally requires quite large amounts of capital. So that's a different story. But as you get more of your own capital and you're more comfortable with what you're doing, there'll be some kind of break-even point where, mathematically at least, you're unlikely to be getting much benefit from investing in an ensemble of funds rather than your own fund. So somewhere between a few $1,000s and not much experience, and several $1 million and plenty of experience, somewhere along that point is a break even at which it no longer it makes more sense, if you want to, obviously, because not everyone wants to manage your own investments, mathematically at least, rather than putting it into a bunch of external funds on which you've got to pay fees. So that's my take, which is a purely mathematical take, if you like.
Exactly. I was just going to say that's kind of the math part. And funnily enough, we're going to talk about math later on today. But that's the math answer, which I don't disagree with at all. But I think there's a bigger question that people always have to ask themselves. And that's kind of life-work balance, right? I mean, because if you want to do what you've done, Rob, people need to take it very serious and they need to devote a lot of time. And not everyone wants to do that. They want to play with their kids. They want to go out for, on a Sunday instead of sitting in front of the computer putting code and having to defend that to their spouse, maybe because they're not spending time with them. All of that stuff you have to take into consideration. So this is why I've often been an advocate of actually using our great colleagues in this industry for making investments. So just keep that in mind as well. Now, here's a nerdy question for you, Rob, a very short one from Bart. Bart says, can you discuss the importance of kurtosis in managed futures? I understand the benefit of skew, but the kurtosis is still a mystery to me. I'm sure it is for quite a few people. So what are your thoughts?
I love the nerdy questions, Bart, so thank you for that. So let's just quickly define what kurtosis is, because not everyone will be familiar. It's just a fancy way of saying a fat-tailed distribution, basically. So if you compare a distribution of returns to a Gaussian normal distribution, then you'll see much more mass in the tails of the distribution than you would expect. So if you look at something like just being long equities, S&P 500, with a normal distribution, there should be a relatively small number of days in which the index loses more than, say, 3 or 4%. But if you actually look at the history of returns to the S&P 500, there's been actually, many times that more days when the index has lost 4, 5, 6, 7, all the way up to the 20% loss that we saw in 1987. So that it's another way of saying fat tails, and the relationship with trend following. Well, it's back to our old favourite subject of outliers. So these fat tails, the idea is that as a trend follower, you want to be on the right side of them, and the idea is that basically, by staying in a position when it's in your favour, you'll hit all these nice fat tails, and then if you get a fat tail against you, then you'll cut your position and be out of it. So the idea is that you can transform a distribution that's kind of unpleasant, like the S&P 500, If you can be short on the days when there are negative fat tails and vice versa, then you'll get the distribution of the returns of your trend following strategy will look like a nice positively skewed distribution with lots of big fat right hand tails, so lots of big fat positive days and a smaller number of days in which you lose a lot of money. So the way I like to think of sort of trend following is you're kind of taking an underlying market's distribution, which you can think of as a piece of clay, and you're kind of squeezing it and massaging it and changing it into something that you're happier with, and making it more positive skewed. And if you have fatter tails in the underlying distribution, then you'll end up with fatter tails in your trend following distribution. And the idea is that hopefully there'll be more on the good side than on the bad side, and that'll be lots of nice, wonderful, positive skew. So that's the general idea. So if you imagine that you've got a portfolio of normally distributed returns, so lots of markets that behave exactly as the finance textbooks would you'd expect them to, and you look at the diversification benefits from holding that portfolio, they're basically limited by the amount of diversification you can get measured through linear correlations, basically. So if you go from one market to 100 markets, the improvement's about 2 to 2.5 times in terms of improvements in risk-adjusted return, which is nice. It's better than nothing. But if you actually look at what you actually get doing that, the improvement's more like 4 or 5 times. It's much better than you'd expect, given the underlying distributions being normal, and it's the fat tails in those underlying distributions that are doing that. So the short answer is, well, we like fat tails because we like outliers, and that's kind of gives us a higher diversification effect, because trend following on a single market, as we kind of discussed briefly with the first caller, is not that profitable. So you need to have lots of markets, and this outlier, this fat tail effect, allows you to get additional diversification from them.
Yeah, cool, good. Last question is from Ross. Ross writes in, for decades, trend followers prided themselves on one set of parameters across all markets in their systematic models. Whether it's X days for breakouts or X days for moving averages or a mixture of both, etc., Jerry and CTAs are adamant against no optimization for each market traded or optimization much at all, if at all, to get their parameter selection curve fit. I know Jerry prefers longer and slower parameters. Question 1. How do you all pick your parameters that you do trade? Throw darts at the wall or take the one that the darts hit? Do you choose a 200-day breakout based on your experience in markets, etc.? Why and how? With that stage set, a little more background. There are probably shops out there that game or hunt CTA stops and parameters. They know what a lot of CTAs use and game them to death and take easy money at times, stop them out essentially. This, among other possible reasons, has led to something I've noticed in the discussions in your podcast. I've heard statements or hints that managers and shops are now using short, medium, and long-term systems parameters to avoid fast crashes or enemy firms gaming their models. Fast, medium, or slow parameters has felt like fancy talk and dancing around what it really might be, curve fitting. Why not just confess the sin and optimize the parameters and get something that will probably be the average of the fast, medium, and slow parameters anyway? And then question 2, is fast, medium, and slow parameters in models a recent development, or can you confirm if this has been done during the 70s and the 80s?
Goodness me, what a question, eh? This actually relates to a little bit to a paper that we'll discuss in a bit. So there's a bit of a theme to this episode, definitely. And this actually comes back as well to the very first question about, which crossover should I trade? So 1664 is kind of fast medium, I would say. And then Andrew said he'd switched to something even faster, and then he wasn't sure what to do. So it all relates together. Well, how do I pick all the parameters that I trade? Is it just throwing darts to the wall, or is it market experience?
Don't you actually have a dart in your shed?
I do.
Yes,
I do.
I see it right there.
Obviously, this being a podcast, you people listening can't see this, but if I move my head to one side, there is a dartboard behind me. Yeah, exactly. But that is not how I pick my parameters. You'd be pleased to know, or maybe not pleased to know. Maybe that would be nice. In all seriousness, you can do tests where if you completely randomize your parameters. It's not a bad test actually of your sort of the fitting of your trading strategy, because you basically want to see the difference between what you've actually fitted and what a completely set of random parameters would look like. Because with some markets there might not be that much difference, to be honest. If you take something that's done very well with trend following in a back test, like say bond futures until quite recently, then randomizing your parameters, you wouldn't necessarily see a lot of difference. So anyway, I'm getting a bit off topic there. So I kind of do a mixture of things. So I'm a big fan of keeping things as simple as possible. And I actually in my production system, so what I'm actually trading right now, if I was to take the example of fast, medium, slow, in fact, that's 3 things, if you like. I've actually got 6 things in at least in my core trend following system. There's a lot of other stuff in there as well. I've got different ways of doing trend following, but to keep things simple, my core kind of moving average crossover strategy, that's I've got maybe 6 speeds. And what I do is very simple in my production system. I basically just say, well, for this particular market, which of those 6 things are cheap enough for this particular market to trade? So for something like S&P 500 on NASDAQ, I could trade all 6 of those. For something like, I'm trying to think of something that's expensive, like cocoa. I don't trade cocoa, actually. But let's kind of stick with the theme and say dry milk futures. They're very expensive to trade. I can maybe only trade one of those crossovers. And then what I do is I've got either one crossover or 2 or 3 or 4 or 5 or 6, and then I just take an equal weight across them. And that's actually not kind of the empirically or theoretically best way of doing it, but it's easily the simplest, and it kind of is obviously very robust to accusations of overfitting, which is obviously what is being thrown at us now. So yeah, that's how I fit that particular thing. And then I have other things I fit, like risk weights for markets and so on and so forth. And it's what I'm trying to do is basically, most of the time my philosophy is, what's the simplest way I can do this, the most robust way I can do this? Is there sufficient statistical evidence to move away from that and do something that's a bit more complicated? If not, I stick with the simplest approach, basically. So yeah, so if you think about, say, a slightly different problem, which is allocating risk weights across markets, with that, if I was to just give each market the same share of the risk capital, that would mean, for example, I would be massively overweight equities, because I have a lot more equity futures than I do have other kinds of futures. And I would be underweight, say, vol futures, because I think there's only 2 vol futures I actually trade. So, that would be, they would have a much smaller weight than they actually get. So that's an example where there's very strong kind of empirical evidence and just common sense that the maximally diversified portfolio is going to have, less equities and more vol than the simple kind of equal weight across markets would. Now, let's get a little bit more into the idea about whether you can actually game CTAs. Okay, so the logic here, I guess, is, okay, well, all CTAs are pretty much doing the same thing. That's the kind of first point. Then what follows from that is that if you can work out what it is they're doing, then you can front run them effectively. That, I think, front running them is a more accurate way of describing what you would do. What you would do is say, if you knew that CTAs were likely to be buying tomorrow, say, based on what's happened in price over the last few days, you'd buy today and you'd hold that position and then close it out. So Ross talks about, stopping out CTAs. I don't think you can necessarily do that, so stop out the entire CTA industry. But if you could predict what people were doing, you could definitely try and front run them. Absolutely. Personally, I think that's, if you try and do that, what you end up doing is trading like a CTA but faster, pretty much. You end up just trying to trade faster trends. So, it's and we know that fast trend following works okay, but it's not. If we talk about fast versus slow quite a lot in this series. To be honest, short, medium, you're using a mixture of speeds is the most robust thing to do. And we already said that to the first guy. Picking a single speed is going to, potentially lead to you being front run if everyone, especially if everyone was doing it. It's definitely more statistically robust. It's definitely more profitable out of sample. It's definitely what you should do. And, I've already described that's what I do, definitely. And as he says in the question, why not just optimize the parameters and get something that will probably be the average? Yeah, if you do a kind of sort of really hardcore statistical optimization and you do it properly, you end up with something that's pretty similar to what I've described already, a kind of simple mixture of fast, medium, and slow with some account for trading speeds. I'll just quickly address the second question, and actually Neil's probably, in terms of historical background, you probably have a better idea of this than I do, but I can only speak to the experience at AHL, where obviously I was working in the, from between about 20 years ago and about 10 years ago now. But also I knew something of the history of how their systems had developed over time. And I do know that their first systems were, just one speed, if you like. But they added other speeds quite quickly. So, we're talking, that would have been done probably in the, 89, 90, 91, that kind of time period. So they weren't trading the kind of very simple, one entry, one stop system for very long, if you like. They added the additional speeds quite early on. I can't speak to the wider CTA industry in terms of developing. I think it's probably quite unusual that anyone is trading a single speed. I mean, even the kind of simple strategy, one entry, one stop, you're probably doing more than one of those, right? You're probably, you've got fast entries, medium entries, slow entries. I say this a lot, but at the end of the day, you end up with things that behave relatively similarly. Okay, and that's why returns in the CTA industry are correlated, because although everyone's doing everything a little bit differently, at the end of the day, if you're trying to find trends and you find a trend, you stay in a trend till it ends, your return profile is going to look pretty similar to someone who's doing something similar to that, but maybe with a fancier approach.
Yeah, no, I mean, very comprehensive answer. I don't know that I have that much to add to it. What I will say, just a couple of observations to Ross. One is, of course, that when you hear people say, well, there's absolutely no optimization in what I do, I mean, don't necessarily means that there's absolutely no optimization in what they do. I mean, we all base our choices somehow on research. Otherwise, there's no point in doing any research and so on and so forth. So I would just say that as a little caution there. I think most people will choose parameters based on some kind of observation, whether it's hardcore data-driven or whether it's a visual thing. Who knows? I think fewer people would use just a visual interpretation of the markets. They would probably have some kind of data to back it up. But I do think that there are maybe two ways of deciding then what the actual model should look like. You can either go by kind of a common sense approach where you would sit down and you would, and maybe it doesn't happen that much anymore, but it probably did back in a few years ago, where people would by committee maybe decide whether we should have 25% short-term models and 50% medium term and 25% long term, and they would move those weights a little bit every year depending on what they found in the research. That's one way, where there is some discretionary element. Another way would be to just simply do it by the data, let the data decide how the parameters would be picked. That can certainly be done. So that's another way of doing it. But my overall sort of sense and answer back to Ross is that the whole thing about gaming the CTA industry, this is something that I've voiced certainly over the years, and I find it incredible that some of these big investment banks are so obsessed with trying to tell the whole world when CTAs are likely to trade, and often when you read the headlines, it's actually not at all what's happening in the portfolios that we come across. So I would be careful, generally speaking. And also I would say there's a lot more going on than just the signal that actually decides whether you have to trade or not on a specific day, the whole risk management side of things, and also just the way managers implement their systems. I think fewer and fewer managers use stops once they become of a certain size, and therefore it's not like you pick their stops. It's not how we manage these portfolios anymore. It's not to say that you can't. It's just to say I don't think that's where most of the money today is invested. And so, yeah, I think it's a fool's errand to try and do that. But if you're some kind of market maker or short-term speculator, not trying to do a trend following system, but just trying to say, yeah, let me see if I can buy today, and as Rob said, maybe tomorrow there will be some more buyers because there are some signals that are generated, and then I can get out later in the afternoon. Okay, sure, if that's what you want to spend your time doing, go ahead, and there's always going to be some times where it works and other times where it doesn't work. Your last question about the shorter term nature back in the 70s and 80s, I think there's some truth to that. I can't remember what we were doing back in that early phase of Don's career. We know from Richard Dennis's experiment that certainly the timeframes they were using initially were shorter term than what they are typically today. So sure, the industry has evolved and timeframes have changed. As I've mentioned before, we do run a study every year to see which look-back periods based on a classic trend-following system would have done best for every single calendar year. And there are years where shorter-term timeframes would have done best. For example, in 2008, even though it was a good year for everyone, actually 50 days was in our experiment here, was the absolute best. But you would have made money even if at 200 days look back. So I think also look back periods very much depend on the type of trend following approach you use. I think breakout will have certain properties in terms of look back, and then other types of trend following might have completely different properties in terms of parameter picks. Do you want to add anything, Rob?
Yeah, two things actually. Firstly, briefly on stops. The reason why stops don't make sense beyond a certain size, if you think about what that implies, it means you're going to close your entire position on a single day. And if you're running like $5 billion, that's probably going to be a bad idea and going to really hurt you in terms of slippage. So yeah, it'd be insane for a multi-billion-dollar fund to be running a single speed and a single stop. That would make no sense at all. I just feel I should defend optimization slightly because I think let's take an example of two managers. One has done a kind of proper back-tested optimization with only backward-looking data, and the other one has said, well, based on my market experience, I know that say a 200-day moving average is best, and that's what I've used. And when I back-tested it, and I found that it's better than anything else, so I haven't overfitted at all. Actually, that manager has effectively done in-sample fitting implicitly. Because they know from their market experience what the best moving average is likely to be. All the back test has done is confirm that they were correct in that. That just means that their market experience is accurate, their memory is accurate. And for them to say that they haven't done any fitting is actually incorrect because they've pulled the best parameter out of the air. That's no different from running an in-sample optimization and finding that 200-day moving average that way. And both of those approaches are inferior to someone who's done a proper optimization that uses only backward-looking data, and that won't result in an unrealistically high Sharpe ratio. Properly done optimization is probably better than not doing optimization at all.
Yeah, no, I think that's very valid, and I think actually what distinguishes firms from each other is, to a large extent, the people who probably know how to do a good optimization without all the mistakes you can make and people who don't. I think that's what shows up over time in the data. So I think that's very valid for sure. Now we're going to shift gear to something completely different for a little while, and then we go back to something that's very common for people listening to this, and that is the U.S. debt ceiling, because this week Treasury Secretary Janet Yellen notified the Congress that the U.S. will reach its statutory debt limit next Thursday and asked House Speaker Kevin McCarthy to either suspend or increase the debt limit. And Janet Yellen wrote that the Treasury Department will begin taking certain extraordinary measures to prevent the United States from defaulting on its obligations. And she also told McCarthy it is unlikely that cash and extraordinary measures will be exhausted before early June. Now, you brought up this topic, so I don't actually know where you want to go with it, but these are just some of the things that I had noticed during the week.
Yeah, I mean, I've mentioned the US debt ceiling before. I think I first became aware of it in 2011 when I was running the fixed income portfolio, and we had this issue with the debt ceiling and also the US being downgraded by the rating agencies. The reason I want to mention it is I just think it's completely bonkers that the world's most economically advanced country is in this situation where they can't actually properly manage the government finances. And on the one hand, those of us who don't live in America could be like, well, this is quite amusing, but actually it has very serious ramifications because US government debt effectively underpins the entire global financial system. So this is potentially quite scary, and it does feel like certain politicians in the US have kind of had this ability to repeatedly point a gun effectively at the head of the global economy and say, right, give us what we want or we pull the trigger. So that's my general despair at the situation. I mean, the political situation in the US with taking all of this time to elect a speaker in the House of Representatives. I mean, it's almost like there are three parties now in American politics. There's kind of sensible Republicans, Democrats, and these people who still believe that the previous president should be president. In fact, still technically is president because he didn't lose the election, right? It's a very, very bizarre and weird situation, and it's a fascinating juxtaposition between the fact that America's this very advanced economic country, home of all the best tech companies on the one hand, and on the other hand, that they seem to have the political level of a much poorer and less developed country. But anyway, the other thing that amuses me about the US debt ceiling is every time it comes up, various people come out of the woodwork with all kinds of creative ways to solve it. So in the past, we've had mint the coin. The idea being here that they could mint this huge coin that would have a notional value of $10 trillion or whatever you needed. This time around, we've had a new one, which is the idea of issuing debt at a extremely non-par level. The reason being that it's only the notional value of the debt that counts towards the ceiling and not the actual market value. So the idea is that you can basically issue a bond that had a notional value of $100, but a market value of $200. You could sell it for $200, and you've then only $100 of that would count towards the debt ceiling. You could use that to recycle existing debt, and then you've basically effectively borrowed another $100. So these things are quite interesting, kind of from a kind of I find them sort of creative finance is also something that I find interesting. But it's just a bit depressing that we're even having to have this conversation, to be honest.
It's somewhat topical, and you wouldn't know why I'm saying that, and that is because in a few weeks, I'm going to publish an episode that I recorded yesterday where Kevin Coldiron, who's the host of the Ideas Lab series, actually interviewed Perry Merling, who has written these books about empires and money, and basically a description of Charles Kindleberger, who was one of the foremost economists in the United States. And it's all about really the Fed and the role of a key currency country, et cetera, et cetera. So there was definitely some interesting points and a very interesting history lesson being shared yesterday. But as I said, it'll come out in a couple of weeks. Now, let's get back to something that we are much more familiar with, which is trend following. And this is inspired by another interesting paper by our friends over at Man. And it's a conversation which ties into what we talked about earlier today, namely kind of different speeds of trend following. They call it the need for speed trend following, and they start out by quoting, actually I think it's Maverick in Top Gun in 1986, where he says, "I feel the need for speed." So they've done a good job in tying it into something that we all can relate to. But they also explain what we mean by speed, and they actually do a pretty good job in highlighting different things within it. So without me taking any of the spoilers away from you, Rob, tell us a little bit about why this is an interesting topic and paper.
Yeah, actually, it reminds me that my last blog post was called "Scream If You Want to Go Faster," which is also a quote from but this time from a pop song. But I won't publicize my blog post because it's not relevant to this topic, although it is to do with trading speed, but it's something a bit different. Obviously, you can go and look at it if you want to. So this was quite an interesting paper. because, and it relates to the discussion we've had actually throughout the program so far. So, which crossover should I use? Should we use a mixture? So one interesting thing is if you actually look at the performance of fast trend following empirically, it's not as good. It's not as good. It hasn't been historically as good as medium and slower trend following. And that's particularly true in equity indices. And it's also particularly true after about 1990. So before 1990, it did pretty well. And then subsequently, performance has pretty much flatlined or even gone down slightly, depending on exactly how you measure it. So based on that, you might think, well, what's the point of trading quickly? And interestingly, if I think back to 2009, Winton famously kind of very publicly slowed down their system on the basis that, that they wanted to reduce costs and they didn't really see any evidence that faster trend following was actually of any value. But this paper takes a more nuanced approach and says, well, actually, the interesting about faster trend following is it has two very good properties. One is it's a much purer kind of protection against the market falling, because it is so owning a trend following strategy is a little bit like owning an option straddle, in that it will do better if the market moves away from where it is now, away from the strike, and the faster you trade, the more pure that relationship becomes. So it has, for example, faster trend following has much better positive skew than slower trend following. It has a lower correlation with the overall market as well. And that kind of makes sense if you think about it. So you can imagine if you were trading really slowly, you would pretty much have been long stocks for the last 40 years. If you were trading slow enough, because there would never have been a drawdown that was long enough or big enough for you to actually kind of stop your position out. Even if you sort of speed up a little bit, there'd probably only be about 3 or 4 occasions in that 40-year period when you would be short or flat, and the rest of the time would be long. So your kind of so-called beta to the stock market would be relatively high, and it would look like you were just owning stocks basically. And the same argument could be made of bonds or any other market as well. So faster trend following, what this means in principle is a faster trend following is actually a much better diversifier to a long-only portfolio, to a classic 60-40 portfolio, than medium and slow trend following is. And that actually overcomes effectively the disadvantage it has from the fact that its net performance isn't as good. So what these guys do in the paper, which is it's reasonably thorough and quite nice, I have to say. But they look at the sort of characteristics of trend following at different speeds, which is, for me at least, is not new information, but it's still nicely laid out. And then what they then do is look at the different behaviour of these different speeds during sell-offs in equity markets. They're always bringing everything back. In this paper, I guess because it's aimed at investors who've got 60-40 portfolios, they're always bringing things back to the equity market or the 60-40 portfolio and saying, how do things compare to that? And they're saying, well, it's definitely the case that in the very worst, sell-offs, you're better off with these faster, having more of these faster signals in them. Now, of course, the downside of trading faster is costs. It costs you more money. So quite rightly, they highlight the point that execution is very important, because costs are going to form a much bigger proportion of your net returns for faster signals than for slower signals. So you can't just willy-nilly trade these things. You have to have good execution. But then the last section of the paper which is probably the most novel and the most interesting for me, is what they basically do. If you're following along at home, this is figure 4, which is quite near the bottom. They look at the drawdown profile of a 60-40 portfolio, and which obviously has been pretty terrible recently, but also didn't look great in, for example, 2008-9, because the sell-off in equities more than overcame the positive returns that were made in bonds, and there was a similar massive drawdown in the early 2000s for similar reasons. So what they do is they take that drawdown profile, and then they say, well, what happens if we add that to a blend of momentum that includes more or less fast and slow stuff, And they find the drawdowns get much smaller if they use an equal blend. So going back to what I was saying about fitting, I have an equal blend of different speeds of momentum. That obviously has fast momentum in it, and that does much better than another blend that completely excludes completely excludes fast momentum and therefore is much slower. So yeah, the bottom line is that the on a standalone basis, fast momentum is kind of take it or leave it. It's not probably going to add a lot of value to portfolio, may even detract from it, but done properly, it can actually improve the diversification properties of trend following versus 60-40. And given that most people are investing in trend following alongside a kind of more standard long only portfolio, even if it's not exactly 60-40, that's obviously a good thing to do.
Yeah, I mean, obviously a topic we've discussed from time to time. I think that, like you mentioned earlier today about volatility, because of course the argument has been made that shorter term strategies will do better during quote unquote an equity crisis. We've certainly seen examples of that where the first few weeks clearly short term strategies should on balance do better. Not so much if the crisis continue, but then we had this year, or I should say this year, but then we had 2022. And actually, it didn't work. And this is also why I think what you're saying is that it's always probably a good idea to have a little bit of everything, right? You shouldn't put all your eggs in one basket and say, well, definitely, this is what I need, and I rely 100% on shorter term timeframes being going to save my portfolio. They don't always do that. There's a lot of other things, but it was a good. Another good paper from them. Do you want to talk about optimal trend following with transaction costs, given the fact we're already at an hour point, or do you want to talk about math?
Let's do that really quickly. So, because it relates to the previous discussion we've been having. So, I said there were different ways of kind of deciding what parameters you should have in your system earlier, right? We were talking about fitting, and I said there's the kind of pick the best number based on your market experience. There's kind of proper fitting, if you like. There's kind of an in-sample fitting. And there's actually another way, which we haven't discussed, which is that it's actually possible to theoretically derive the best parameters of what your trading strategy should look like. And the way you do that in principle is you make some assumptions about market behavior, and then you wheel in a lot of very, very fancy maths. And you then sort of say, well, given these assumptions, given this, what's the optimal strategy to maximize my performance here? And the nice thing about this approach is you don't need any actual data to do it, so there's no real fitting going on. Now, that's a slight caveat here is that if the assumptions you've made are themselves based on the kind of observed market behavior, you've actually sort of empirically calibrated your model, then you could argue this is sort of fitting by the back door. But if you can minimize the amount of that's going on, then that's obviously good, and you can theoretically end up in a situation where you've used no market data at all to sort of say what's going on. Now, it's a nice approach to use. I've used it myself, and I thought I'd mention this particular paper, which is called Optimal Trend Following Transaction Costs. It's available on SSRN. I'm sure I'll put a link on the page. And what these guys do is basically they take this approach. They say, well, given some assumptions about market behavior, without any data, so no fitting involved, what's the best trading strategy to capture trends, given that we have transaction costs? Because without transaction costs, obviously, for example, faster trading would be better than slower trading. And the nice thing is that they recover something that looks very much like the kind of moving average crossover that I'm in particular is extremely fond of. So, it's just a nice, neat little model. Not really of any practical value, to be honest, but it's nice to have your models confirmed by another source of evidence, if you like. So, as I said, different sources of evidence. Some of those you can accuse people of overfitting, but this particular approach uses no data at all, so there's no fitting involved. So it's a really clean kind of tick in the box of, yes, this is a good way to capture trends.
Fantastic. Good stuff. Well done. All right. Last point is something which is a little bit different because we're into the British politics of some sort, but then we're combining that with math. So tell us a little bit about what we're going to talk about.
Well, our Prime Minister this week is Rishi Sunak. It's quite hard to keep up with who is Prime Minister in the UK at the moment. It's a bit like living in Italy, but both the weather and the food is worse. And he gave a speech recently, and one of the things he said was that everyone at school in the UK should study maths until they're 18. Most people at the moment have the option of, at the age of 16, of switching to, most people in the UK, they basically do A-levels, which means you're doing 3 or 4 subjects. So obviously you're narrowing things much further. Not many students subsequently do A-level maths, which would be studying maths up to 18. And there are obviously various arguments to be made as to why this is a good thing. But it was a point of focus for me yesterday, actually, because yesterday I gave a talk to a local secondary school about careers in the financial markets and trading generally. And one question I always get asked is, well, how much maths do you need for this? How much maths do you actually need to do what you do, or to work in the financial markets? And so, and actually, it's like, well, there's actually quite a difficult question to answer, because there's a huge range of jobs in this industry, right? I've worked with people who stopped doing maths at 16 and went on to do something entirely differently. For example, to take an extreme example, I work with people who, did Latin or Greek at university. So, very, very much at the other end of the sort of scientific spectrum. But they're working in jobs where the main skill they need is the ability to deal with clients and get on with people. And that's something they obviously did very well. And then the other extreme, you've got people who are, I have to say, much cleverer than me, with PhDs in maths or physics, who are working on either particularly advanced trading strategies or working as quants and doing things like derivative pricing and risk management and so on and so forth. Personally, I think I kind of sit roughly in the middle of that spectrum. So I did A-level maths, and then I did economics, which is kind of obviously not a real science, but is a subject that has a fair degree of mathematics in it. So to bring it back to trend following, to just follow a basic trading strategy that somebody else has already developed, and we know, without needing to worry about back testing, optimization, all of that kind of stuff. Yeah, high school maths is I would say more than enough. And actually, one of the things I've tried to do in my writing is to do things that don't require advanced maths as much as possible. And literally, I don't think I've ever used, for example, the integral sign in anything I've ever written. So, because I think to a degree that's not necessary. It's definitely helpful if you are backtesting to have at least an intuitive understanding of statistical significance, and potentially, ideally, to have more advanced statistical knowledge if you're really going to get into the weeds of this stuff. There are use cases where you would need very advanced maths, but I think generally the amount of maths you need to do this job is probably quite overrated. But that's my opinion anyway. I'd be curious to know what other people think.
Yeah, no, absolutely. It's a good point. And I actually think you're absolutely right. I mean, in the industry as a whole, there's definitely room for lots of different talents, because we can't all be super quants and just look at the screen all day. So it's a roomly industry, and it's a fun one, and it's never dull and always changing, and actually, because it ties into whether you're systematic or not, it all ties into what's going on in the world, because that affects how markets are moving. So I think there's something for most people to enjoy. Yeah.
I would say actually that it's useful to have people from a different mixture of backgrounds. So, if I was starting a hedge fund, I'd probably, for example, employ a historian. Because I'd want someone who has an understanding, and I'd probably employ a politician and someone with a background. Sorry, not a politician, but someone with a background in politics, and someone with a background in geography, and because all of these things feed into how markets move. Definitely. What are you? I'm trying to remember. Is your background physics, Niels? I can't remember.
I wouldn't say it's physics, because I didn't study anything after high school. So I have absolutely no credentials to to this. Yeah.
So there we go.
I'm proof that you don't need a lot of math to
definitely
to do this. Yeah, absolutely. Yeah. I am learning by doing. So there we are. All right, good stuff. I think we're going to wrap up for today. This was fun, as usual. Thank you so much, Rob, for all of that. Now, if you haven't left a rating and review until now, this is your chance. We would love to if you would take 5 minutes to do that, it really does help. And if you don't know how to do it, you can go to toptradersunplugged.com/review. And then there's some instructions that I hope you will take us up on. And as usual, you can send questions to us, and that you can do by email, info@toptradersunplugged.com. Next week, it'll be with Rich. So I'm sure he would love to tackle some of your questions. So by all means, send them through to us. With that said, that's all from Rob and me today. Thanks so much for listening. We look forward to being back with you next week. And don't forget, by the way, check out the new, in my own unbiased words, completely amazing series of conversations with the absolute best minds in our industry starting on Monday that I'm doing with Alan. I think actually the first one up in the series is someone that you know very well, as it is the CIO at Man AHL. From Rob and me, as I said, thanks for listening. Take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.